All right, time to kick off tonight's session. What an interesting time for investing. I tell you, it is a challenge for everyone. I just want to welcome you to tonight's session. I see we got about 85 people on, and hopefully we'll get more on to share their questions, share your ideas, your thoughts, and all of that. Feel free to make comments in the comment section and to ask questions. As I say, it's a very tough time for investing, but it's also a time that you can make or break. I think one of the big lessons that I've learned from investing is that there's times when you want to take a big risk, and there's other times where you just want to kind of protect yourself. And I would say that right now, I'm comfortable with not making big bets to try to make a lot of money on something and protecting the value of the investment. And so that means that if the market bounces or something bounces, I may not capture all of it, but I'm okay with that because I know that the risk is that things can get really bad. So, all right, I'm going to get started. Is anybody got any? I don't see any comments yet, so I just say hello to everyone out there. Feel free to put a comment if you've got anything that you want to ask about, anything that you're thinking about. I'm going to share my screen and get started in the presentation. I'm going to go through this presentation, but you can ask questions at any time, of course. So let me now go through the presentation a little bit and highlight some points. Tonight's presentation, we're going to go through the weight update for all weather strategies. That means all three of our strategies that we have through phenomena. So we're going to try to do it all in one, and you're going to get a lot out there. So I see some comments coming in. Anita says, hello, John Andrew. In my whole ports only, your AWS port is still positive. Yay! Well, we're trying our best. Sati Mehdi says, hi. Jamari says, good evening. And what's the other one? Andy, I can't read that one, but hi. And then Nan says, hello, Andrew. All right, let's get into the presentation. What are we going to talk about? First, what happened in the world markets in August of 2022, performance review of our strategies, That's the all-weather inflation guard, the all-weather strategy, and the all-weather alpha focus. The global outlook that guides our asset allocation and new weights of our strategies. Again, all three of the strategies we're going to present tonight. All right, great. So we're going to talk about what happened in world markets today. I just want to take a moment. We've got 143 people in the show. I appreciate all of you, and feel free to leave your questions and any comments that you may have. I'm happy to try to take them. I see Seiko Anitsuka says, Sawadika Ajan Andrew, and Tanet Kato says, hi, I'm a first-time listener here. Well, this is your chance to go through some of the concepts that we talk about, but also, Tanet, feel free to ask any questions if something's confusing, because my goal is to help you to understand what we're doing. Eat, sleep, play. Oh, that's good. Hi, Mr. Andrew. Good to see all of you. So let's get in and look at what happened in the world markets in August of 2022. First, world stocks have taken a hit in 2022. Can look at the red line on this chart, and we can see that world stocks were up 19% in 2021. Year to date, 2022, they were down about 17.5%. And in August, world stocks lost about 3.6%. So it's not easy to make money in that kind of an environment for anybody. Now let's look at all the markets. This is a summary that I do to try to understand what's going on. First, US was weak in the past month. This data is as of the 12th of September. So it's not the month of August, but just 1 month as of the 12th. And China was also weak, particularly Hong Kong was weak. And key European markets fell as well. European markets were down by about 6%. One of the big questions, and we're going to talk about that, is should we be allocating to Europe? When should we be allocating to Europe? So you can always go to my valuationmasterclass.com and just download the resources right there. And you can get that chart that I use, that table that I use every day. So bonds did well in August. Bonds is the blue line we're looking at, and all bonds performed well besides tips. Commodities were the second best performer in August. Commodities have been on a bull run since April of 2020. What's going on with commodities? Well, what we can see is agriculture was the best performer. Energy prices weren't helping performance. The WTI oil price closed August of 2022 at $89 a barrel. So it's come down, and it was flat in this particular period. Corn and cotton drove agriculture as the market expects lower supply in those areas. Now, gold has fallen in 2022. Gold closed the month at $1,711 per ounce. So let's look at some interesting things that I've been watching. The market has begun to expect the Fed to hike faster and higher. And here is Lisa Abramowitz, who says war is inflationary, which Credit Suisse Pozar says. And he says he sees a risk that the Fed will raise benchmark U.S. rates to 5 to 6%. That's crazy. There's no way the Fed's going to raise rates that high, because they're going to destroy the economy and they're going to destroy the stock market. I would disagree with that statement. Here's a funny picture of Chairman Powell in front of a crashing market. So the EU redistributes to the troubled member states. This is an interesting situation. We know that Italy is in a very, very difficult situation, and they have a lot of debt, and therefore the bonds of Italian bonds, the yields are rising very high. But the point is that with very high yields, that means, of course, prices of Italian bonds are crashing. So what's happening is that the ECB is taking money out of German bonds, and hence their net purchases of German bonds are negative, and they're taking that money to buy Italian bonds. And the point is that for the Italian bonds, it's unnatural. Right now, interest rates should be very high on Italian bonds, but what they're trying to do is keep the EU together. And that's part of the game that they're playing. Now, investors are pessimistic about Europe. Here we can see investors increase bets against the euro. We've already seen the euro collapse quite a bit in value. And I would say that Europe is heading into a very difficult time right now. So that is what I would say about what's going on with Europe. Here we can see, this is kind of crazy. I know in Thailand, when I traveled up country, when I first came to Thailand, a lot of people were burning wood and coal that they had or charcoaled wood. Here we can see the Google searches for firewood in German language has gone up massively. It's crazy to think that German people are having to go out and get firewood for energy. And here we say only a few may have enough to pay their winter bills. So here's a funny one with a stack of dollars and other currencies saying, I've already put some money aside to cover my electricity bill here in Germany. Germans are paying a massive amount for their electricity. And it's really all come down to the U.S. not willing in any way to talk with Russia over Ukraine. And the result of that, of course, is continued devastation for Europe. So German producer price index overshot already high expectations. It's massive what's happening in producer prices. That means producers, not the retailers. Producers are the ones who supply the goods and services to the retailers. So these are factories and warehouse type of businesses that are passing that on, and it's just going through the roof. And that, of course, will push through to consumer inflation, retail inflation. Here we can see German CPI saw new records as well. So that PPI is feeding through into CPI. And to be fair, power prices seem to be coming down in Germany. This is a chart that shows German 1 year ahead power price is almost half within 2 days. So there is some movement. I think it's a question that we can ask. And that question is, have we passed the peak of inflation? That's the question that we can ask. And I think we'll have a little bit more talk on that. Before I go any further, I just want to welcome everybody here. We got 201 people in the show, and I'm just going to bring up a couple of quick questions I see. Peter says, how much percent should DCA each month for the current situation? Well, I think, this is a good question for DCA and the current situation. Remember that we now have 3 strategies: low risk, moderate risk, and high risk. Let's say that your client is moderate risk, and so they're investing in all-weather strategy. Keep in mind that we are switching allocations between equity, bonds, gold, and commodities. And so I would say that from a DCA perspective, you want to continue the same level of DCA every single month, because that allows you to accumulate money when the markets are down and when our portfolio is down. Adam Sanders says, from your idea, how much percent would be in DCA in the current situation? Again, this is a critical element. DCA only works when you consistently add money to the market, and let's just say an equal amount. Let's say that your client has $200,000 in monthly salary, and they decide that they could invest 30,000 baht versus 200,000 baht, and they take that 30,000 baht every single month they do DCA. Generally, you're never going to change that. Now, if the market absolutely collapses, you may decide that you're going to increase that DCA, but generally, I wouldn't change DCA. All right. Anne says, yes, good to see you, Kun Andrew. All right, Anne, TT, good to see you. Supergone, you come with CPI tonight. Yes, we'll bring some CPI. All right, so Japan uses pine wood and US uses Hollywood. That's a good one. I like that. Would like to hear your view about commodities. It seems to consolidate and ready to move up. Well, let's continue on with the presentation, and I'll go through some of that commodities. So let's go and look at where we're at. And basically, France's energy crisis is worse. Basically, you can see this chart. It shows that when we look at Germany and France for electricity, it's France that's really seeing a huge increase in electricity costs. And I'd say right now, our minimum allocation to Europe is 5%. And I would say we're probably far away from starting to increase our weightings in Europe. The French government prepares its people for a tough winter. Prepare for a hard winter with less gas available. OPEC, and actually you may think to yourself, wait a minute, I'm not feeling this that much in Thailand. Remember, in Thailand, we have the Thai government who is subsidizing different costs. And basically from that subsidy that they're doing, it just means that they are smoothing out the increases in price for Thai people, but that won't last forever, particularly if things continue to go high. Now, this is an interesting one by Tracy Chi Girl, and she says, OPEC continues to miss production targets, not helping on the supply side. So if OPEC is slow to produce oil, and we've already got high oil prices, that could push oil prices higher. High gas price could hit farm yields. This is an interesting story where European fertilizer giant Yara has cut its European ammonia capacity utilization to about 35%. Everywhere we see across Europe, they're cutting back in industrial capacity because they don't have the inputs. In my global investment strategy that I wrote a few months ago, I talked about the concept that World War III has just happened. And what has been World War III? World War III has been US against Europe. Now, what do I mean by that? For World War III, what I mean by that is that I mean that the US has destroyed the independence of Europe. And the result of that is that Europe is now in a very difficult position. Now, higher prices hit poorer countries the worst. Here we can see protests in Pakistan, in South Africa, in Bangladesh. It's going on across the developing and emerging world. And there's voices of concern about China. Here is the government strategy for over-leveraged properties is to lend more money to finish them and pretend everything is fine. What I would add to this, China right now has definitely got a property problem, but I would argue that China has to solve the problem. If they can't solve the problem, they're going to have a collapse. And if China has a collapse in property, it's going to bring down Chinese banks. And that is a big concern. So what are the key takeaways that I want you to get from this section? Number one, the market expects the Fed and the ECB to hike aggressively, even if it causes recession. Europe's energy crisis is far from over. Global inflation is hitting the poor nations the worst, and slowdown concerns for China as well. And as of right now, we're not allocated to China. So now it's time for some performance review. We're going to start with all-weather inflation guard, the low-risk strategy. And here we can see that the performance has been above a 40 equity 60% strategy. So since inceptions, AWIG has outperformed the strategy by about 0.7, the benchmark, as of the 12th of September. Now, we just started this in July, so it takes time to get some performance, but I'm happy to see that we've done okay so far with this lower risk strategy. So inflation guard was down slightly in the month of August. The strategy was 0.7% better than 40-60. Let's now look at all-weather strategy. Here we can see that it's been above a traditional 60% equity, 40% portfolio. We've lost some of our gains, but as I said at the beginning of this, I would rather be a little bit defensive during this time and not take a big risk, lose some of our gains, but hold on to the value of our portfolio. So the strategy was 6.3% above a 60-40 portfolio as of the 12th September 2022. And remember that this includes all the costs involved. So it is really a true measure. All right, I just want to take a second here and hold on. We have 220 people that have come on the call. I just want to thank all of you for spending this time. I know it's hard. Everybody's busy. You may be sitting in a car. You may be sitting in your office. You may be sitting at home. Hopefully, you're not sitting in a big puddle of water as we've had so much rain in Thailand. But I'm here tonight to talk about our strategies for your benefit. So if you have any questions, you have any issues or other things that you want to talk about, feel free to go ahead and just make a note and let me know. All right, let's continue on and let's look at the 1.7% outperformance by AWS in the month of August. Commodities were the second best performing assets. Japan was best. Unfortunately, we didn't allocate to Japan this time, so we missed that. And the third best performing was bonds, and gold was down, but the fourth best performing asset. So right now we have 5% allocation in Japan, so we caught a little bit of that, but not the total value. Now remember that my goal is that AWS loses less on down days. This is a chart worth spending a few minutes on, and I'm just going to pull out my pen just to highlight what's going on this chart. When you look at this chart, basically what it's saying is that the market is the blue line. Now we'll say that the market in this case is the benchmark, 60% equity, 40% bonds. And here we can see when the market was down 6.4, AWS was down 5. When the market was down 5.6, AWS was down less and less and less. Each time it was down less, except for one time here where it was down more. And occasionally that happens, but it wasn't a big one. So generally what we're doing with this is trying to lose less when the equity markets fall. Of the 10 worst days of global equity since the inception of AWS, the strategy has lost less than the 60% equity, 40% bonds on 90% of the days. So AWS outperformed a 60-40 strategy in 62% of the months. In 26 out of 42 months, the all-weather strategy has beaten a traditional portfolio. Of course, that means that it's lost many months too. And that's the point, is that you're never going to win them all. All right, let's look at all-weather alpha focus. This is our higher risk strategy where we're trying to make more tilts in equity. Here you can see that we are above a 60-40 portfolio since inception. Alpha focus was 1.5% above the 60-40 portfolio as of the 12th of September. Alpha focus has held up when world equity has fallen. So remember, alpha focus is trying to tilt into countries, into sectors, into equity, but also we have other asset classes to try to protect the downside. And that's exactly what we've done. If you had just put your money in world equity, you'd be down 85 to 85.4, right? So down about 15%. But here you can see that the performance is at 92.7. Again, this performance, we try to make the calculation after fees so that you can get the real calculation. So Alpha Focus was 7.3% above world equity as of 12 September 2022. Alpha Focus was 2.5% above the 60-40 portfolio, and it was also 3.6% above world equity. Our tilts to world energy, India, and commodities paid off. All right, what's our global outlook that guides our asset allocation? I want to talk about global outlook for a bit, and after that, I'll show you the new allocations. So let's first talk about equity. Jay Powell seems ready to bring on the pain. He said, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. Here we can see that a September Fed hike is priced in. The market is pricing in 100% certainty of another Fed rate hike at the next FOMC. The implied probability is 88% for 0.75 hike to a target of 3 to 3.25. Now, some of you remember that I've talked about how I don't think the Fed is going to increase interest rates. I was wrong on that. The Fed started increasing interest rates much more aggressively than I thought. Now, one of the lessons that I want to share with you that I think is an important lesson, and this has to do with risk management. And that lesson is, just because you have a view, for instance, I think commodities are going to fly, or I think inflation is going to be super high or whatever, be careful not to allocate all of your resources to that one thing, because what if you're wrong? Then you've lost a lot on that bet. And if there's one lesson I've learned in years in the markets, you're going to be wrong plenty of times. So my advice is to focus on making some tilts, but never move so aggressively that you're putting all of your money into any one bet. And I would argue that that's one of the benefits you get when you invest in our different strategies, because we are not taking huge bets like that. So let's go back to the presentation and we'll go through some other points. Since March, market expectations have shifted to a much more aggressive Fed. So the solid line that shows that the expectation is that interest rates, the Fed target rate is going to be at about 4%, 3.9% by the end of 2022, this year. That compares to an expectation at March of this year at 2.0%. So people are raising their expectations that the Fed is going to continue to raise rates. I'm going to tell you why I don't think that's going to happen, but let's at least acknowledge what's going on. The Fed needs to balance inflation with expected recession expectations. And yeah, and Nan says, don't fight the Fed. What it really means. Yes. In fact, I did a great interview on my podcast with Danielle Martina Booth, and she's really good. She used to work at the Fed. She wrote a book called Fed Up, and she talks about her biggest mistake she ever made was not just going with the Fed and going with liquidity. So yield curve inversion has been an accurate predictor of recessions in the US. And here we can see when the yield curve gap, right? When the yield curve gap between long-term and short-term goes negative, we see that all recessions in the US since 1970 were preceded by an inverted yield curve. That means the short end of the yield curve is higher than the long end of the yield curve. And that's when it goes below the line here. We can see this is 10-year treasury minus the short-term 2-year treasury. And here we can see that we're already below the line. So the average time from inversion until the recession started was about 1 year. So according to this measure, which has never been wrong, we are heading into a recession. Now, there's another chart that I was looking at recently today that showed that the majority of Americans think that they're already in recession. So I think you could argue that the risk of that is coming. Now, let's look at ECB. The hike in July brought the key rate to 0 compared to where it was 0 at 2014. So they kept it negative for many, many years. Like the Fed, the ECB reiterates its commitment to combat inflation. In fact, part of my point about how the US went to war with Europe is that Europe now follows the US on just about anything, even if it's going to be destructive for them. So here we have 0.75% hike at the September 8th meeting, and further hikes are expected in October. ECB needs to at least keep up with the Fed in terms of hikes. If not, the euro could weaken further and exacerbate the trade deficit. So here we can see that there hasn't been much quantitative tightening or QT. If we look at the central balance sheet, banks' balance sheets for Fed, ECB, and BOJ in Japan, we can see that if we rebase them to 100 back at 2020, before the crisis came, we can see on this chart This period of time is the COVID crisis where the Fed printed a lot of money, but they kept that going throughout all of this time. And this is quantitative tightening, which is in fact not really tightening. It's just neutral quantitative. It's not like they're going through a tightening phase. And my point is they can't tighten like that, because if they started to tighten like that, who's going to buy US treasuries? Basically, we don't have China anymore buying treasuries. We do have Japan and some others. There will be some buyers, but nobody as big as the Fed. So that's an an issue. Let me get a glass of water. Now, here's where I have kind of a controversial opinion. I think that the Fed is going to reverse course. You could call it the Powell pivot. Many central banks are communicating that they're going to get inflation down, and investors seem to buy it. They're expecting it. But we still think that central bankers and politicians will change course and return to accommodative policies like quantitative easing as soon as something breaks. Though many indicators look negatives for stocks, we see some opportunities to allocate to specific sectors and specific markets. So I just want to talk briefly about this statement. Basically, everybody expects the Fed is going to continue to raise interest rates. But my point is the U.S. economy is very fragile. You've got companies have a lot of debt, but more importantly, the government has a huge amount of debt. And all the companies that are, let's say, moderate to high risk, these guys are going to be struggling to get money. Also remember that the banks in America haven't been lending for years. Instead of taking the deposits that depositors give them and lending that to companies, what are they doing? They're lending it to the U.S. government, and they're doing that by buying U.S. treasuries. The second thing they're doing is holding a lot of cash, because regulations after 2008 required that the banks hold a lot more cash. So now you've got almost 20% of the balance sheet of U.S. banks in cash, and almost 20% of the balance sheet of U.S. banks in U.S. Treasury bonds. That's 40% of the balance sheets that are in risk-free assets. And basically, they're waiting out the situation, but they are not providing funding into the market. So what could go wrong? What could break in the market? One of the big things that could break, and we saw it in the 2020 COVID time when it first came in March, is that yields on high yield bonds and moderate yield bonds started rising fast. In other words, their prices were collapsing and their yields were rising super fast. And the gap between these high risk bonds and government bonds, let's say a government bond was 2% and the high risk bond was at 5, then 6, then 7. The gap between this is what we call the high yield spread. And this high yield spread has been widening recently, and I think that it could widen more. And at that point, it's one of the things that could break. The other thing that could break is just simply the stock market. So one of the questions that came in from Supergone says, will credit crunch happen at some point? I think definitely. Keep in mind, the Fed is the buyer of last resort. What's happening now is that they're no longer a big buyer of U.S. treasuries. And that means that somebody else has to buy U.S. treasuries. Maybe Japan will pick up some of those treasuries, but generally it's going to be the people that pick up those treasuries in the U.S. and some foreign countries like Japan and Europe and the U.K. But the point that I would make is that when you have a buyer that's willing to buy any bonds from the government in the market, it keeps the interest rates super low. But as soon as that buyer, in this case the Fed, pulls out of that market, all of a sudden you are reducing supply of buyers for government bonds. And therefore, the government has to start to increase interest rates to compensate and to attract borrowers. Now, the question is that you ask is, can there be a credit crunch? Well, the first credit crunch will be the U.S. government, and they're going to have to kind of scramble to get funding. The second credit crunch that I would see is companies. Now, what we can see is that large, high-quality companies tend to be okay when they get their funding. It's small, middle-sized companies, higher risk companies that can face a credit crunch where they just can't access credit. The banks already haven't really lent out loans. If you think about Thailand as an example, Thai banks have lent out a lot of money over the last 10 years. But over the last 10 years in America, they've lent out almost no money. And so really, the bond market is where most companies are able to get their money, but small, medium-sized businesses don't have access. So there is the risk of a credit crunch for sure. So let's continue on, and that's my discussion about why I think something will break. Now, stagflation is the worst possible outcome. If central banks manage to kill growth in the economy, but not inflation, we get stagflation. Stagflation is typically bad for both stocks and bonds. We get the rise in prices with inflation, but without the rise in the economy. Commodities have typically done well during inflationary times, and gold has historically fared well during stagflation. Given the various possible outcomes, we like to be diversified across the asset classes. I feel like right now is not an easy time to call what's happening in the market. I'm going to sit down on my desk here for a second, so hold on. Now, let's continue. The strong US dollar hurts emerging markets. Well, we know that. We are feeling the pinch in emerging markets. Everything is priced in dollars around the world, and they're getting more and more expensive. Fed actions are likely to result in a stronger US dollar and less global liquidity, which could hurt emerging markets. US dollar is considered a safe haven. It can strengthen further as a result of the global turmoil. Here we can see poorer emerging markets in Asia could be hurt by European energy crisis. Europe is so desperate for natural gas that it's importing an LNG cargo all the way from Australia. This is a great graph or map that shows what's happening. Basically, it's coming from Australia. It's going through the Straits of Malacca in Malaysia, and then it's going through the Suez Canal, and then through the Mediterranean Sea, and then to Spain. That's crazy. So as Europe is desperately trying to find enough energy, prices keep rising. Richer countries are likely to outbid poorer countries for energy. That hurts poorer countries' energy supplies and also their fertilizer. Strong US dollar and China concerns are another thing. The stronger US dollar is negative for many Asian countries due to the dollar-denominated debt that's getting harder to pay back. Now, that was a big thing for Thailand back in the 1997 crisis. We had so much US dollar-denominated debt. For Thailand, we're not in that situation anymore. China's not in a major situation with US dollar debt compared to the size of its economy. But some countries do still have some debt. Now, we're not yet convinced about the Chinese recovery. The Chinese government is trying to support the economy, but appears cautious not to use too much stimulus. And again, as I mentioned, we have a risk in the property market that could lead into the banking sector. China's heavyweight matters. Here we can see that China's heavyweight in the emerging markets in Asia Pacific ex-Japan indices could continue to be a drag. All right, let's talk about bonds. But before we go to bonds, I want to just switch for a second into question from Tanet. The question is, if no one is going to buy U.S. Treasury, does this mean the bond market, both government and corporates, not really appealing, given that the interest rates also increasing? Well, the reality is that the U.S. government needs to get money. And basically, they're going to get it from the Fed. If they can't get it from the Fed, they're going to try to get it from the banks. Now, the problem that you face is that if the Fed were to be no longer be a buyer of last resort of government bonds, let's just imagine that the Fed said, we're out of the bond market. We're not buying any bonds from the U.S. government. The U.S. government's going to have to go out to the people of the U.S., to foreign investors, and try to raise that money. And right now, interest rates are pretty low, so the U.S. government would have to raise the interest rates to attract those investors. But the problem that you have is that a large portion of the costs of interest, of the total spending of the U.S. government, is interest. And in fact, I was listening to someone talk about an estimate that like in the next 10 years, the interest on the debt will consume a huge amount of government's budget every year. So that is a risk. The next question from Supercon says, rate increases and inflation will hit a lot of consumption, less money circulating in the company revenue too. Will it lead to stagflation, right? So yeah, I think that rate increases and inflation will slow down, and that's exactly what Chairman Powell is saying that he's trying to do. Now, I think it's important to mention that I am someone who believes in what's called shareholder capitalism. I don't believe in stakeholder capitalism, and I even have some questions about ESG and sustainability and some of that. I have some doubts about that. Of course, I'm a free thinker, and I like to think differently about things. But what I would say here is that I really don't want the government involved in setting interest rates ever, like the Fed, because they mess it up. Government fueled the 2008 boom in real estate prices and the subsequent bust. And so they fueled it, and then they cut interest rates so low and kept them down there for 10 years. They caused so many troubles and problems. And now we got to count on the Fed to try to save the day. They're constantly behind. They're constantly messing up. I do not have confidence in the Fed leading our economy. But unfortunately, we don't have a choice right now. So I got to deal with what the Fed gives. So to answer the question, will we have a hit on consumption? Yes. That's the point, is that the Fed is trying to slow down the U.S. economy. Now, it is important also to mention that many people think that the crash in the stock market or in the economy is the problem. But no, as Peter Schiff says, who articulates it very well, the crash is the solution. The boom is the problem. When you have a boom in the economy, you have overinvestment, malinvestment. Anybody's got money. They're investing in all kinds of projects. And when the market collapses, that is the good part of the market because it cleans out the bad performing companies. So I am really a free market guy. All right. Nan says, JP Morgan, Morgan Stanley, Goldman Sachs, Citi. Bad news and good news from these is reliable for our investment. In your view, what should we deal with these news every single minute? So this is a great question. What is the job of JP Morgan, Morgan Stanley, Goldman Sachs, and Citi? Just like any broker, I was a broker. I was an analyst at a broker for 20 years at different brokers. What we are trying to do is get you to trade. That's what a broker does. If they can get you to buy or sell, if they could get you to buy on one day and sell on another, they'd make commission on that. So I would say that the job of these investment banks and of brokers is to flood the market with their research and their ideas. If you try to keep up with what's coming out of those investment banks that you mentioned, plus all of the brokers and other organizations and financial firms, you'll go crazy. So for me, I really, really, really limit my consumption of all the different information. I'm looking for a small number of people and of organizations that I can trust. And I do a lot on Twitter, as you see Twitter slides that I have in here. So don't try to get all the information from everyone. It's a losing game. All right, let's go back and continue on. Now we're going to talk about bonds. So bonds are typically a safe place to be in recessions. Safer assets like government bonds are typically performing well, though with high inflation, low yields could still lead to negative real returns. We typically don't allocate to bonds to speculate on the upside, but rather use the bonds as a way to protect capital over time. What about commodities? Well, energy prices have come down. Natural gas in Europe has come down quite considerably, but it's still at 1,000. We've rebased it to 100. So it's up 10 times from where it was in January of 2021, just a year and a half ago. Europe's Russian energy dependence is continuing to influence the energy markets. OPEC keeps missing its output targets, leaving tight supply. So Fundamental support for energy prices while Ukraine war could lead to further supply shocks. Energy prices can also remain high due to past underinvestment in new projects. So we can see that because of ESG pressure, many of the energy companies had to stop investing in capex and new exploration. A reopening of China could lead to increased demand for commodities. Here we can see high energy prices feed through to food. Cereals fell back in July and August, but we still think that these are going to be high because natural gas is used in fertilizer, and pricier fertilizer means higher grain prices. One of the world's largest fertilizer producers have cut their production by 50%. Corn is a common feed of livestock and poultry, and it's driving up meat prices. What about the food price index? We've shown this before, but we can see that it has come down from its recent peak, now from about 160 down to about 140, let's say. And that's, good news to see it come down, but I expect it's still going to be high. Export bans on food could exacerbate food shortages and push prices up further. Oils and cereals drove down the index in July, falling 19 and 11% respectively for oils and cereals. And oils dropped the most in August as well. So commodities, we think, still have some ability to run. As Zoltan Pozar says, global supply chains work only in peacetime, but not when the world is at war, which we're at right now. Demand for necessities like food and energy, inflation, and supply chain disruptions related and unrelated to the war in Ukraine are going to drive the asset class higher. Also, if we were to go into a stagflationary period, commodities could show resilience. Let's talk about gold. Here we can see that we keep gold as an insurance. We're not trying to bet on the move of gold. We're trying to protect the downside. And the war in Ukraine spurs uncertainty, and inflation expectations could rise, making gold attractive, though expected rate hikes and recession concerns are negative. So what are the key takeaways that I want you to get from this section? Number one, central bankers appear to be raising rates into a recession to stifle inflation, and stagflation could be the worst outcome. Demand for necessities, inflation, and supply chain disruptions are going to drive commodities higher. That's what we're expecting at this point. Bonds and gold we use to protect the capital. All right, ladies and gentlemen, it is time to announce our new allocations. Drum roll, please. Announcing new allocations. First, the all-weather inflation guard, our newest strategy that we've brought to Phenomena. Here we can see that we keep equity at 30% and we're increasing tips. What does that mean? Well, we've increased the inflation-linked bonds to 15% from 10%. And we've reduced Thai medium-term bonds by 5%. Why is this significant? Well, we're just concerned about inflation, and a TIPS bond is going to give us a little bit more compensation in an inflationary period. But as far as equity is concerned, we make no changes to the equity position. We expect high inflation to stay high, which already is high. So we increase our target allocation to these inflation-linked bonds from 15 from 10%. All right, time to look at all-weather strategy. Here we can see no change whatsoever. We're keeping 25% equity, 25% bonds, 25% commodities, and 25% gold. Now, within equity, we have a 5% minimum allocation to each region. Keeping in mind, as we've talked about before, never tilt your portfolio too aggressively one way or another. This is a way that we prevent ourselves from tilting too aggressively. And all-weather alpha focus. Here we can see more defensive equity allocation down to 63% from 73%. So for our most aggressive strategy, the alpha focus, we've now gone into a little bit more of a defensive mode. We're reducing world energy and we're getting out of India. I know we've had a lot of questions about India over the last couple of years. And finally, after a great run, We're going to move out of India. We're going to increase healthcare and infrastructure, and we're going to add 3% in U.S. equity. We're going to raise bonds to 13% and gold to 20%. And we're going to reduce commodities in this strategy to 4% from 20%. Let's look at some of these bets that we're making. U.S. stock market to be relatively strong. U.S. dominates global markets. The U.S. dollar is typically a safe haven. And we can see Fed rate hikes as of right now are bullish. We think the U.S. stock market can show resilience relative to others. Now, demand for healthcare and drugs is independent of economic conditions or cycles. In line with a more defensive positioning, we increase our world healthcare target allocation to 16% from 4%. What about infrastructure? Don't you love that picture? That's a great picture. As infrastructure is typically essential to a community, infrastructure assets are typically not impacted by economic cycles. In addition, the cash flows are typically stable and predictable. So we increased our world infrastructure allocation to 16% from 4%. U.S. has the infrastructure investment. China has announced a plan, and Europe's investing in green energy. Overall, the spending should be supportive of world infrastructure. All right, let's look at the risks. The first risk is a global recession pushing down stocks. If central banks are too aggressive with rate hikes and QT, which I think they could be, it could crash stock markets and hurt our equity position. Now, we're mainly exposed to Thai bonds, hence the bond performance is most sensitive to the Bank of Thailand's actions. What about inflation? If inflation quickly gets under control, well, we're positioned to benefit from rising inflation through our commodity allocation, and weak Chinese economy could reduce commodities demand, leading to lower prices. And other commodities could fall with energy prices too, as it's part of the production costs. What's the next risk? Well, global recession pushing down stocks that we own. If major central banks would surprise and be too aggressive with rate hikes and QT, it could crash stock markets. Increased risk appetite could lead to defensive positions in world healthcare and infrastructure underperforming. And a change in expectations towards lower inflation and interest rates could lead to poor performance for gold. That ends the main part of this presentation. I'll take any questions that you may have, and I do believe I have another short presentation that I'm going to share with you. So let me just open up that presentation. One moment. I just want to highlight that we have the boot camp upcoming. So I'm going to share the screen here and just remind you, if anybody on the call or children that you have or other people that you know want to learn more about valuation, they should consider joining the Valuation Masterclass Bootcamp on October 10th. It's exciting. In fact, we do have some people right here who are from Phenomena. In fact, I can see a couple here. Here you can see Kelly, and here you can see Anne, two people from Phenomena right there. So you get the best deal. You're going to save $800 until September 20th. Just use Phenomena code and just go to valuationmasterclass.com/bootcamp. I think Alex will put that into the chat. So if you have any questions, feel free to ask. All right. It's time to ask a John Andrew. Do you have any questions? Feel free to ask any questions that you may have. Don't be shy. We've got 204 people on here, and I know you guys have questions, so feel free to ask away. The question you may ask is, did my mom have dinner yet? And yes, she did. In fact, she had a nice dinner and a glass of wine, and then she just went to bed. All right. Any questions? Feel free to ask any questions. Otherwise, we'll end the session tonight. We've had about an hour together, and that's when I get exhausted because I wake up about 4 a.m. this morning, so it's been a long day. Alex has the information that he just put into the chat, so if you're interested in about valuation, feel free to check it out. Love to have you in the Valuation Masterclass Bootcamp. We've got 195 people on this call. If you have any question, feel free to ask your question now. Of course, you may be sitting there eating your dinner and thinking about what you want to do next, so no problem. But if you've got a question, feel free. All right. Kunatip says commodities 25% in AWS, but 4% in AWAF. That means commodities will decrease in the short term. Well, I think that it's hard. First thing I want to tell you is that our strategies for Alpha Focus and all weather strategy, we've constructed them very different. So sometimes you may see a diverging method or diverging investment, such as commodities in this case. And you have to look at it in somewhat of a holistic way for each portfolio, because in the case of Alpha Focus, part of what we looked at in the beginning was how can we maintain an equity position but still have the ability to be defensive? And that's where we really started. But Kunatip, you could say that Alpha Focus is taking a bigger bet and it's betting on taking out commodities, and maybe all weather strategy will get out of commodities next time around. It's possible, and you could be right, but we don't know until we get to that point. All right. Jean-Marie says, in your view, how long will be in this hard situation when everything's better? I would say probably another 12 to 24 months. It could even be longer. The problem that we face now is we really, really run the risk of war. And that's a serious concern. I think we also run a major risk of starving hundreds of millions of people across the world. And that can cause all kinds of chaos. So I would say best case, 6 months. Worst case, 2 years. All right. Nan says, your view on global or Asia REITs and property, good investment now or not? Generally, when interest rates are rising, it's not great for property. However, a lot of property is REITs. And if a REIT, think about it this way, if inflation is rising and interest rates are rising, basically what's happening is that REITs are not able to reprice that quickly, right? And so they're kind of slow to reprice. So I would say that REITs could do okay, but it's not an area that I'm particularly interested in, particularly when interest rates are rising. It usually is negative for them. But also keep in mind, like in Thailand, as an example, there are good REITs that provide good yields. So it's not an impossible investment. It's just not that attractive to me right now. All right, let's see. Andrew says, what's your outlook on Vietnam? Well, it's interesting, Andrew, that you asked that question, because I've been asked that question many times, and I've said, people have asked, why are you in India and not in Vietnam? Well, now we've reduced our Indian position, but we haven't increased our Vietnam position. And that would tell you that we are just still not positive on Vietnam right now. Narong Chart says, what if the Ukraine wars end sooner than expected? Will it help energy crisis in Europe? Yes. The first thing that will happen is that energy prices will likely come down pretty significantly. But I would also argue that that could be kind of a temporary thing, because remember, just because the war ended, it doesn't mean that that Russian gas is going to be allowed back into Europe and everything's fine. It's going to take time. But I would argue that the first step, Narong, is that energy prices would come down. But then what you'd see is that supply is not going to increase that fast, because I don't believe the US is going to let Russia come back into the global system that easily. Best says, why did you underrate energy? Doesn't OPEC still have strict production? Remember that we use FVMR, fundamentals, valuation, momentum, and risk. And there's sometimes that we're making a bet based upon momentum. And right now, momentum for energy is not super strong. And so that could be part of it. Supergone says, good to hear no change in AWS. I'll add more money tomorrow. Yep, that sounds good. All right. Kunatip says, thank you so much. My pleasure. All right. Who else we've got? Salaya DC. Can Thailand survive this difficult situation? That's a good question. And I would say Thailand will be okay. The biggest problem that Thailand faces is that we're a big energy and fertilizer importer. The good news about Thailand is that we have been a food exporter for many years. So if things got really terrible worldwide, and we couldn't even get as much fertilizer as we want, we still have a large population of farmers that are making a pretty good output out of their farms. And the result of that is that we should have food independence. That's good because not every country like Sri Lanka, also countries like Egypt, countries like Pakistan, these countries don't have food independence, and therefore they're struggling. Thailand will have high inflation, and I think that that's kind of an issue. I haven't looked at Thai banks in a long time, but I can tell you, I'm sure that they suffered during the COVID time. But I believe that the Bank of Thailand will do what it has to keep them strong. So can Thailand survive? Yes, Thailand can survive. Next question, AK, could be a lost decade like Japan. Yeah, it could be. I mean, for Thailand, I would say we've already been down for a pretty long time. So hopefully things can turn a bit. But yes, we could have that. All right, let's see. Supergone says, how do you view to keep physical gold versus gold fund? Well, Supergone, did you ever know of the man named Dr. Suwan Walai Satian? Dr. Suwan was a great investor, and he was a good friend of mine. Unfortunately, he's passed away. He lived at Sukhumvit Soi 8, and I live at Sukhumvit Soi 12. When we worked together on some deal, I used to ride my bicycle over to his office, and then we'd sit and talk. But I talked to him, what are you doing with your money? He says, there's nothing I enjoy more than just going down to the bank, opening up my safety deposit box, pulling out my gold bars and putting them on a table, looking at them, and then putting them back into the safety deposit box, and then putting it away and going home. So if you have the ability to hold some physical gold, I think that there's a lot of value in that. Gold fund is, something different where you're trying to get access, you're trying to get movement in momentum in gold price. You're also trying to protect on the downside for a portfolio. But I would say that nothing wrong with having some stock safely stored of gold, physical gold. Tanet says, can short-term corporate bonds issued by U.S. banks be better than government bonds? It's possible. I'd say if you can get short-term bonds by government banks, by U.S. banks, the benefit you have is their balance sheets are super clean. Remember, we looked at 20% of their balance sheet in cash, 20% of their balance sheet in government bonds. So I think that the quality of the U.S. banks is very good. But the quality of U.S. banks will never beat the quality of the U.S. government. Why? Because the U.S. government can always print money to pay you. Now, they can cause inflation from that and devalue their currency, but they will always make their payment. So the answer to that is short-term corporate bonds issued by banks, so we can say bank bonds, could be attractive, but they'll never be better than government bonds from a risk perspective. Itzuri says, it's a good time to invest in AWS. Should I wait a bit more? My clients now plan to allocate only $500,000 for this port as of now. I would say it's not a bad time. I've talked about how we could be 6 months to 12 months away to 24 months away. I mean, there's no way of knowing. But I would argue that, it's probably getting to that point where it's getting interesting. Maybe if AWS could come down another 5 or 10%, it's possible. But I would say keep in mind that our portfolio for AWS is not heavily exposed to the stock market compared to bonds, gold, commodities. So the chances of it like falling, if somebody says, I'm going to wait until that's fallen 20% or something like that, the chances of that are very, very low. So it's probably not a bad time, but some people may say, well, I'll wait a little bit longer. Monica says, will tonight's CPI numbers affect the Fed's strong stance on inflation? Probably not. I would say that the Fed's probably going to try to increase substantially the next time. and whatever comes out on CPI. But I would say that, remember, what my opinion is that the Fed will continue to try to raise rates, but they're going to break something. And when something starts to break, there's going to be panic. Keep in mind, the Democrat Party is trying to get the Democrats elected and keep control of the House and the Senate. And of course, they'll put pressure on Chairman Powell to make sure that if something breaks, that he tries to fix it. Nan says, India out, it run well over 1 to 2 months. Any risks that I foresee? I don't see any major risk. Remember that when we are allocating, it's looking at what's the relative attractiveness. And that is really the key. And right now, the relative attractiveness of India is not that strong. Pornweepa says, if I begin to invest in AWS now, is it a good time or should I delay? From my perspective, I think that you kind of want to DCA invest, dollar cost averaging, into these strategies and not try to make big switches. Like, for instance, take all of your money out for a couple months, then go back in. Remember, I'm doing all that allocating in the strategy. So from my perspective, I would say going in and continuing to contribute on a regular basis is really what you want to do. But I would say talk to your advisor. Remember, I'm not your advisor, because your advisor through Phenomena has all of the knowledge and ideas about you, about your situation and all that. All right. Any other questions? I think you guys really came through with a lot of good questions. So here's our CPI numbers, 8.3% year on year, CPI 6% month on month. Wow, 6% month on month. That seems pretty crazy. All right. Well, CPI came with tonight's event. And I would say, again, that CPI number is not going to have any major impact. I think that Powell is going to continue to try to increase interest rates until something breaks. All right. That's it for tonight. I'm going to go and I'm going to, 0.6. Yeah, that's a correction. 0.6 month on month, which is a little bit more reasonable. If we look at that and we multiply that times 12, we can say that that's about 9% or so. So it is still, a high inflation number. All right, I'm going to go and eat a little bit of food before I get ready for bed. I want to thank everybody. We've got 200 people on this call. You guys rock. I appreciate that you take the time to come on here, and I certainly appreciate all your questions, and I appreciate my partnership with Phenomena and my ability to bring our strategies to you. So I just want to say thank you to everybody. Let's have a great night. Make sure you get home safe if you're at home. Give your family, your friends, your loved ones a hug, as I just gave my mom a big hug. Celebrate that we're alive, we're safe, we're happy right now. And let's continue to steadily, step by step, grow our wealth over time. See you guys